Welcome to the Ontario Mortgage and Real Estate Insights podcast, where we keep you informed on the latest developments, trends, and regulatory changes affecting the real estate industry. I'm your host, Steve Hamilton. Today, we're diving into a topic that's been on everyone's minds lately: the recent interest rate cuts by the Bank of Canada and what they mean for the housing market. Buckle up, because we've got a lot to unpack. The Bank of Canada recently made its second interest rate cut in a row, trimming its benchmark rate by 25 basis points last week. This follows a similar cut in June and strongly signals that more rate reductions could be on the horizon. But what does this mean for the housing market? According to Doug Porter, chief economist at the Bank of Montreal, the impact might be more modest than some might hope. Porter suggests that while the rate cut might improve buyer sentiment, it is unlikely to set the housing market on fire. The variable rate is still well above longer-term rates, and the longer-term rates aren't really moving that quickly, he says. So we probably haven't seen just enough relief yet. In other words, a few more rate cuts might be necessary to significantly boost the market. Interestingly, Porter also mentions that the current tepidness in the housing market might actually be a good sign. He describes the lack of a dramatic rebound as a relief, suggesting that a sudden resurgence could be detrimental. We almost need a period of calmer markets to help improve affordability a little bit, he explains. This perspective is quite intriguing as it highlights the complex balance required to maintain a healthy housing market. Victor Tran from Rates.ca echoes this sentiment, noting that while the recent rate cut may not immediately boost home sales, it could improve the outlook for variable rates. This could make potential buyers more comfortable stepping off the sidelines, but it is unlikely to move the needle in a significant way just yet. So how many more rate cuts can we expect? The Bank of Canada has left the door wide open for more reductions before the end of the year. Porter believes that the central bank's tone suggests 2 more rate drops in the next 2 announcements are a distinct possibility. This dovish stance is a stark contrast to the bank's previously hawkish approach on rates over the past couple of years. One of the more unusual aspects of the recent announcement was the bank's direct reference to Canada's unemployment rate. The central bank noted that signs of slack are emerging in the labor market, with the unemployment rate jumping to 6.4%. This is a significant increase and something that has the bank concerned. Porter points out that the unemployment rate has risen more than a percentage point in the past year, which is not typical outside of recession periods. It's now risen more than a percentage point in the past year. That's a bit disconcerting, he says. It's not normal to see the unemployment rate rise that much in a year. Usually it only happens during recessions, and I do think that's got them a bit concerned. Another factor to consider is the potential divergence between the Bank of Canada and the Federal Reserve in the United States. While the Fed has resisted calls to lower rates, the odds of a rate cut in the U.S. are increasing. Bank of Canada. Governor Tiff Macklem seems to be more relaxed about this potential divergence, even if it means tolerating some weakness in the Canadian dollar to bring rates down. However, inflation remains a potential complication. Porter notes that wage growth is still pretty sticky, which could make it more challenging to reduce inflation than the Bank of Canada might hope. This adds another layer of complexity to the central bank's decisions moving forward. In summary, while the recent rate cuts by the Bank of Canada are a step in the right direction, they are unlikely to cause an immediate surge in the housing market. More cuts may be needed, and various factors such as unemployment and inflation will play crucial roles in shaping the market's future. Stay tuned as we continue to monitor these developments closely. As housing costs soar, landlords in Ontario are increasingly using own-use evictions to reclaim rental units, leaving tenants scrambling to find new homes. Own-use evictions in Ontario have increased by 85% since 2020, according to data from the Landlord and Tenant Board. The number of own-use eviction applications, known as N12 notices, filed with the Ontario Landlord and Tenant Board has climbed from 3,445 in 2020 to 6,376 in 2023. These applications allow landlords to evict tenants if they or a family member plan to occupy the unit. The number of T5 applications, where tenants dispute the eviction claim after vacating, has also risen sharply, from 331 in 2020 to 1,335 in 2023. This surge in disputes indicates a growing tension between landlords and tenants in the province. Chris Kostav and Sherry Keys, tenants in a low-rise building in East York, Toronto, are among those facing evictions. Their landlord has filed N12 eviction notices, claiming he needs the units for his family members. Kostav, a retired electrician who has lived in his studio unit for nearly 20 years, suspects the true motive is to re-rent the unit at a higher price. "I think the only reason he wants me to leave is so he can charge higher rent," Kostav, who currently pays $600 per month, told CBC. He fears becoming homeless if forced out, as his pension will not cover the increased rent costs. Keys, 56, fought her eviction and recently won a ruling from the Ontario Landlord and Tenant Board that her landlord had acted in bad faith, allowing her to stay. "The rents everywhere are so high, we knew we could not afford anything else. We had to fight because we have been worried about the possibility of homelessness this entire time," she told CBC News. Their landlord, Sofiane Bousselmi, denied acting in bad faith, insisting that he needs the units for family members. The conflict reflects wider tensions in a market where average rents have surged 22% in 2 years. According to rentals.ca, the national average for a one-bedroom apartment is now $1,929. Carly Wilson, a housing lawyer in Toronto, noted that many tenants are fighting to stay in their homes despite challenging conditions. "People are clinging to their homes with their fingernails like they are. They are desperately clawing to stay in their apartment, even if that apartment is terrible," Wilson said. "I tell my tenants if they have been anywhere for more than 5 years, they have a target on their back. Tenants will refuse to leave an apartment for years because they know they have nowhere to go." Landlords, however, argue that their need to repossess properties is genuine, often citing rising costs and mortgage rates. Rosemarie, vice chair of landlord advocacy group Small Ownership Landlords of Ontario, explained, "If you have to pay $800 a month for your rental property, and then your mortgage needs to be renewed for your principal residence, and you have to pay another $600 or $800 for that, you cannot afford it. You cannot just pass that monthly increase over to the tenant. So then who is paying it?" Jessica Huang, a landlord who joined a recent protest at Queen's Park, expressed frustration with the delays in processing eviction cases. "I am a single mom, and I cannot afford to keep paying for a rental property I no longer live in. I need to move back in, but the process is taking forever," Huang said. Like many small landlords, Huang is caught between rising costs and the legal complexities of evicting tenants. The Landlord and Tenant Board reported a quadrupling of T5 applications, filed by tenants disputing own-use claims after vacating, from 331 in 2020 to 1,335 in 2023. Fines for bad faith evictions more than doubled from 11 in 2022 to 23 in 2023. Wilson pointed out the challenges tenants face in disputing these claims. "It is an easy way to get somebody evicted, honestly. An N12 does not have a high burden of proof. It just requires one person saying, 'I want to move into this unit.' And unless you can prove that they are lying about that, which is hard, you kind of have to go with it," Wilson said. Starting August 1st, first-time homebuyers in Canada will have the opportunity to take advantage of 30-year amortization periods for insured mortgages. But there is a catch. This extended amortization option is only available for those purchasing new builds. This announcement was made on July 29th as part of the 2024 budget package, which also introduced a Canadian mortgage charter. Finance Minister Chrystia Freeland emphasized the government's commitment to making homeownership more accessible for young Canadians. "For every young Canadian who wants to own a home of their own, we want them to be able to qualify for a mortgage and afford their first home," Freeland stated in a news release. She highlighted that one of the biggest barriers to homeownership for younger Canadians is the challenge of qualifying for a mortgage and managing the monthly payments. Currently, mortgage lenders impose a maximum 25-year amortization period for insured mortgages where the down payment is less than 20%. This policy often leads to higher monthly mortgage payments for first-time homebuyers, who typically have smaller down payments. By extending the amortization period to 30 years, the government aims to reduce these monthly payments, making homeownership more attainable for younger Canadians. This meant that first-time homebuyers who often have smaller down payments faced higher monthly mortgage payments, explained Canadian Mortgage Services on its website. Expanding the length of payment for first-time buyers means younger Canadians will have more affordable monthly mortgage payment options, the government said. By stretching the loan over an additional 5 years, the monthly amount becomes more manageable, Canadian Mortgage Services added. The lower payments free up more income, allowing them to qualify for a larger mortgage and potentially enter the housing market sooner. The introduction of 30-year amortization periods is also expected to stimulate new home construction, as first-time buyers look to take advantage of this new incentive. However, it is important to note that extending the amortization period also means paying interest for an additional 5 years, which can significantly increase the total cost of the mortgage over its lifetime. Canadian Mortgage Services cautioned that being tied to a 30-year mortgage impacts financial flexibility. Adding 5 extra years to your mortgage also means you are paying 5 more years of interest, and being tied to debt for 30 years also impacts your financial flexibility, they noted. They advise working with a mortgage professional to find the best rate and term that aligns with your financial situation. The 30-year amortization period aligns with the government's tax-free first home savings account, which has already helped over 750,000 Canadians save for a down payment more quickly. The combined effect of these policies aims to make the dream of homeownership more achievable for young Canadians. For more details on how to take advantage of these new measures, you can visit canada.ca. Whether you are a first-time homebuyer or someone looking to understand the evolving landscape of the Canadian housing market, staying informed about these changes is crucial. A recent report from Statistics Canada has revealed that the number of short-term rentals in Canada has grown significantly since 2017, with units that could be considered usable for long-term housing growing even faster. According to the report, the total number of short-term rental units in Canada grew by 60% between 2017 and 2023. The number of units considered potential long-term dwellings, or units that could be long-term housing, rose by 80%. Back in 2017, there were 58,441 short-term rental units that could be considered potential long-term dwellings. By the end of 2023, this number had risen to 107,266. The report also highlighted that in 2017, potential long-term dwellings made up 27.2% of all short-term rentals. By 2023, this share had increased to 30.2%. The report describes potential long-term dwellings as entire housing units being listed for more than 180 days. This does not include vacation-type properties. However, the trend was not linear and was broken by the first 2 years of the COVID-19 pandemic. Total short-term listings fell by 19.2% from 2019 to 2021, while potential long-term dwellings listed for short-term use fell even more sharply, with a 28.1% drop. The report attributes this decline to a decrease in tourism activity. The report suggests that after the decline in tourism during the pandemic, many property owners may have converted their short-term rentals to long-term rentals. This could explain why 2022 marked a low point in the proportion of potential long-term dwellings, as many thousands of units may have still been tied up in 12-month leases during the onset of the recovery. The report adds that this activity may support the notion that these units could be used as long-term dwellings. Nationally, potential long-term dwellings accounted for 0.69% of the total housing stock in Canada by the end of 2023, which is an all-time high for the country. The share is rising across several provinces. In Ontario, for example, the share of housing units more than doubled from 0.35% in 2022 to 0.69% in 2023. In Quebec, there was a jump from 0.38% in 2022 to 0.51% in 2023. In both British Columbia and Prince Edward Island, this share exceeded 1%. The share of potential long-term dwellings in the total housing stock was significantly higher in tourist areas. For example, in Whistler, British Columbia, potential long-term dwellings made up 35% of the total housing stock. A spokesperson for Airbnb commented on the report, stating that the number of potentially long-term homes was a small percentage of the total housing stock. Despite some concerns with the methodology used, as the report concludes, the number of short-term rentals that could be used as a potential long-term home is less than 1% of the overall number of homes in Canada, a small fraction of the 22 million homes needed by 2030 to achieve affordability. Nathan Rotman, policy lead in Canada for Airbnb, told Global News in a statement. Rotman added that restricting short-term rentals would not solve the housing crisis. While the share of potential long-term dwellings as a share of Canada's housing stock may appear low, John Pasalis, realtor and broker at Realosophy Realty, emphasized that the absolute numbers also tell a story. There are over 100,000 short-term rentals that could have been used as homes for families, he said. He pointed out that this number is very high for a country where annual housing starts barely exceed 200,000. According to the Canada Mortgage and Housing Corporation, housing starts in centres with a population over 100,000 declined nationally from 240,590 in 2022 to 223,513 in 2023. Pasalis said this speaks to a philosophical question in housing policy. Is housing an investment or a right? These units are being used as standalone hotel rooms for investor profit rather than as housing, he said. We in Canada value investor profit over housing. Now, let's turn our attention to a fascinating trend in the Canadian housing market this year. Despite slower than expected sales levels and an increase in property listings, some regions have experienced notable price hikes. According to a study by Zoocasa, which analyzed data from the Canadian Real Estate Association, Northern Ontario and the Prairies are leading the way in rising home prices. Let us start with Northern Ontario. Of the 26 cities analyzed, 3 cities, North Bay, Sault Ste. Marie, and Sudbury, have seen more than a 10% increase in benchmark single-family home prices since January. These cities have not had as many new listings as other Canadian markets. In June, new listings were below the 5-year average in Sault Ste. Marie by 11.2%, in Sudbury by 6.6%, and in North Bay by 9.5%. Sault Ste. Marie, in particular, has seen consistent price growth and remains relatively affordable. Since January, its benchmark single-family home price has risen by 12.6% to $305,000. Outside of Ontario, the next largest price gain for single-family homes has been in the Prairies. Since January, prices have increased by 9.8% in Edmonton, 9% in Winnipeg, and 8.4% in Saskatoon. However, home prices in these markets have remained below $500,000. Despite the slow spring market, most areas have experienced more than a 5% jump in single-family home prices since January, including the Greater Toronto Area and Greater Vancouver. However, benchmark condominium prices have not increased as much. Of the 23 condominium markets analyzed, 12 have seen less than a 2.5% increase in benchmark prices since January. 5 markets experienced less than a 1% increase, including Hamilton, Burlington, Ottawa, Niagara Region, Windsor, Essex, and Winnipeg. Interestingly, Canada's most affordable condominium markets are also experiencing the most price growth. Units in St. John, Edmonton, and Saskatoon saw the largest price gain since January, increasing by 13.9%, 13.1%, and 10.8%, respectively. These locations are seeing growing demand for condominiums, with price growth higher than that for single-family homes. The same trend is observed in London and St. Thomas, Calgary, and Regina. A recent survey by Zoocasa found that 42.3% of respondents cited rising home prices as their primary concern in the current market. This concern could be driving demand for more affordable property types like condominiums, contributing to their rising prices. That wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. I hope you found our dive into the latest developments in the Canadian housing market as fascinating as I did. Stay tuned for more updates and insights in our upcoming episodes. Thanks for joining me, and until next time, take care.